Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we get to talk about my largest investment, which is Salesforce. Now, if you haven't seen me talk about this company before, this is going to give a brief overview because this company just had its Investor Day presentation. And so I want to talk about what this company does, what things are looking like in the future, talk about some of my numbers that I have behind this company, and all the good stuff that you need to know around the bullet points and just basic direction that the company is going. It is my largest position in the portfolio because I believe right now it is the most undervalued that it's probably been maybe ever, if not at least in the last several years. So I am owning this company with the belief that it's going to continue to grow top line and bottom line results. And I'll talk in this video why I believe that's the case. So stay tuned. It's going to be a fun one. Thanks for tuning in. And if you haven't seen me before, my name is Jordan. I'm a Millennial Investor, and I showcase my growth and dividend growth portfolio through these two portfolio holdings right here using M1 Finance, the brokerage that you're seeing on the screen right now. Now, if you want to take a look at either one of these for yourself, or if you want to use this brokerage, if you think it's cool and you find value in it, you can check that out down below in the description. We have referral opportunities for the M1 Finance brokerage, savings accounts, credit card referrals, and all types of good stuff like that, which can be checked out down below in the description, which 125 people have signed up for so far. You'd help support me, you'd help support the channel, and if you haven't seen it as well, here's also my performance and my current balance as of the time of me filming, which is $35,000, and this is my performance year to date, which PS, by the way, if you didn't see my recent video when I was shorting Tesla, we just closed out that position for a $1,151 gain just last week. So I did want to update you guys on that, and then I'll close that out. But without further ado, let's go ahead and jump into Salesforce. Now, Salesforce is a subscription revenue company that has been growing its long-term revenue for decades now. It started around the time that I was born in 1999. It's actually only 4 days older than us, if I remember. I think it was February 1st, 1999. I think it's only like a couple days away from my birthday. It's really weird. But anyways, this company has a long-term track record of growing bottom line free cash flow as well. If we go back just 10 years ago, a decade ago, this company produced $420 million in free cash flow. 10 years later, in the most recent year, it did $5.28 billion with a B. So definitely a huge ramp up, over a 10x in 10 years, and this company is not stopping anytime soon. And even if you look at the most recent quarters, despite this recession, this did not stop in 2022. The last couple quarters have been growing nicely, with the most recent numbers coming in at 24 right here and 22% growth. And this factors in even the foreign exchange, the FX headwinds that we've been seeing with a stronger dollar in 2022. So these numbers would actually be higher, especially in the most recent quarter, probably around 24 and 26% if we had to factor that in. Now, not only has this company been growing a long time, but the total addressable market, or the TAM, is still projected to grow at the same 13% CAGR, compounded annual growth rate. Now, last year when they had this investor day, they projected a 13% CAGR, and they kept that number that it is still projected to grow at the continual rate of 13%. Now, here's the cool part. The reason this company is growing more than 13%, as of most recent, like we said, they were growing 22%, is because of two things. One, their existing customers are spending more and more on their company, and we'll talk about that in a second. But the other reason is that they're taking market share from competitors, like old school companies like SAP and other big names like that. They're continually stealing market share, which allows them to not only grow fast, but grow faster than the overall market size itself, more than 13%. And I think that this will continue for quite a while. Now, something else I want to talk about, and this is what's so important to me. This is actually a slide that was not on here last year. This is actually something I didn't know until last week when this came out. It was that the 20% of customers make up 85% of ARR. And of that ARR, which is annual recurring revenue, by the way, that all comes from customers that have 4 clouds or more. Now, here's why that's important. Over time, this company has become more profitable. It's become more efficient, especially on a long-term track record. For example, if we look at the company's free cash flow, it's consistently grown faster than that of the revenue, especially in the last couple of years. Because while the expenses are going high, you can tell that it's not growing nearly as fast as compared to the top-line revenue. You see this uptrend in long-term revenue, but if you look at some of the expenses, specifically ones like the sales and marketing, it's kind of starting to flatten out. Same thing for CapEx. It's actually basically not even gone up at all while the revenue continues to go higher. So as your revenue goes higher and your expenses go lower or even flatten out, you can tell that the profitability starts to get higher and higher over time, and this becomes more apparent on an annual basis, right? Now, the important part about this is that the most locked in customers, the ones that it's harder for them to leave, are the customers that are up here, that have more than one, that have 4, 5, 6, 7 different products that they're paying for. So much of their business is represented behind Salesforce's products that it's almost impossible for them to leave. So these customers that only have one product, or maybe even two, they could leave at any time because they can find another Salesforce, they could find another competitor out there to do the same thing. But when you have 4, 5, 6, 7 different clouds you're paying for, you're relying on them so heavily, and most of the revenue is coming from these customers. So these customers that only have one product, if they were to leave, it doesn't hurt them that much because almost all the revenue is coming from these big customers. Now, moving forward, something I wanted to talk about, you can see my little projections here based on where I need the share price to be to hit my $1 million goal by the time that I'm at the age of 40, which I track every single month, every single year on this little portfolio here. Let me zoom out so you can see better. I have my annual goals here to get to $1 million. So if you haven't seen that before, here it is. But this is where I need the share price to be. And based on these metrics and these predictions, which I think are very conservative, which fall below their estimates, I think that this is pretty interesting to see that they're still projecting a $50 billion fiscal year 2026 revenue target, which represents a 17% compounded annual growth rate. Now, based on my estimates, which are intentionally conservative, my midpoint is a 12% revenue growth. My bullish is a 14% revenue growth over that time, and they're projecting a 17% growth despite this horrible recession and factoring in $2 billion of foreign exchange headwinds as we get a stronger dollar. Now, it goes further than that. It's not that this company is only growing at 17%. This is something that I was also extremely shocked by. As this company has gotten more profitable, like we talked about, with those expenses starting to shrink, apparently is about to start changing dramatically over the next couple of years because the non-GAAP operating margin is projected to be 25+% by 2026. Now, what is the non-GAAP operating margin today? Well, let's scroll over to operating margins. Last year, it was 18.7%. This year, it's projected to be 24.4%, and this is how they get there. This is the non-GAAP if you want to see this chart right here. It basically, you take the GAAP margin, you add back the amortization of purchased intangibles and the stock-based compensation, and the actual free cash flow that they're producing from their non-GAAP operating margin is 20.4% is what is projected to finish out this year. Now, this year is already a big ramp up, pretty dramatic improvement over last year, but they're projecting that to break 25% by 2026, which is only a couple years away. So not only is this company still growing its top line, but profitability, which is what's really important as an investor, is expected to expand quite dramatically. And that's what you see in numbers like this. $10 billion in share repurchase authorization. So let me give you an example of a company, which I like this company, don't get me wrong, this is not a company that I hate, but something that I don't like about Netflix and why I pulled the trigger and I keep waiting and waiting for a lower price is that this company's net income skyrockets. You see that last year they produced $5 billion in net income. But if you look at their free cash flow, it's actually slightly negative. Now, this doesn't mean it's a bad company. There's a lot more to look at than just this. I'm not saying that. But when you look at their actual cash position, you see that it goes down year over year because the company's not producing cash. You cannot do share buybacks. You cannot issue dividends. You cannot buy other companies without producing real cash flows. And this is going down despite this company continually issuing debt, which over the last several years continually goes higher and higher. I love Netflix. This is not a shot at Netflix, but to give you an example with Salesforce, this is a company that because they produce cash flow so consistently, you see their debt pile. Let's look at the quarterly chart so we can get the most up-to-date numbers. Let's look at their debt pile. They made their huge acquisition. That's what this huge jump up is right here. They bought another company. They bought out Slack. But ever since that acquisition, it started to trend down for the last year and a half, right? It's went down from 9.8 billion down to 8.7. It dropped $1 billion. But not only did the debt drop $1 billion, but in that same time when they issued these shares and issued this debt, during that same time after that deal went through right here during this quarter, not only did the debt go down $1 billion, but the cash went from 9.6 up to 13.5. So they paid off $1 billion worth of debt and raised almost $4 billion worth of cash, which is a net benefit. 4 plus 1 equals $5 billion in total cash generated, which lines up pretty similar to what we see in these numbers right here at about $5 billion in free cash flow during those last two big quarters. Now, this is what's cool. I love seeing companies grow and adapt like this, coming from an unprofitable, high-growth, speculative company to now being a grower at scale, as you see here, a profitable grower at scale at that. So Salesforce has a long track record ahead of it. I don't think it's going to end anytime soon. The huge compounded annual growth rate, the massive market opportunity, the compelling operations that this company has in locking in customers early on to buy 3, 4, 5, 6, 7 clouds, which brings in the bulk of the revenue. I think that this long-term track record of growth is only getting started. What this really reminds me of, when I think of a company similar to it, it reminds me a lot of Microsoft. During the 90s, during the 2000s, when people were just figuring out Microsoft would get installed in their computers, people were having to be sold on the product. People were having to say, what's Microsoft? What's Microsoft Windows? What does it do? Is it worth buying? Well, now it comes as a standard. And so that's what takes this teeny little revenue where it's just a couple billion right here. And look what this company was hitting 7-8 billion. That was in 2002. Well, that's where we're at today for Salesforce, is about this level. I think that Salesforce will eventually see the same thing with Microsoft, with rising and rising and rising revenues. And then, of course, like with Microsoft, just with any other company, including Salesforce, the profitability will come. During this same time period in 2002, it was doing 13 billion in profitability, and today it's doing 65 billion. 65 billion in profitability, and I see a similar track record for Salesforce, except the one difference being Salesforce valuation right now at $147 billion market cap is quite low in my opinion. So thank you guys so much for watching. I appreciate you watching all the way to the end. Check out all the stuff down below in the description if you haven't already. Get signed up with M1 Finance for a free $10 and you'd help support me and the channel. My name is Jordan. Thank you so much for watching, and I'll catch you guys next time.